Podcast is now starting. All attendees are in listen-only mode.
Hello everyone, thank you for joining the call today with Red Wealth Australia. So today we have both the founders, Adrian Rivish and Benjamin Fusco, to give us more insights on Red Wealth. Red Wealth was established in 2002 and currently manages a property portfolio of over 1 to 5 million Aussie dollars. So we will give this time to them to share with us what are the property market outlook in Australia and what are the potential investment opportunity. So I'll hand it over to you guys, Adrian and Benjamin.
Hey, good evening everyone, how are you? My name is Adrian, this is Benjamin.
Hey guys, welcome tonight. Thank you for this time.
Yeah, before we actually get started with the presentation, I just want to take 1 second and thank MasteryAsia, specifically with Casey and his team for putting this event on together. We've had the privilege of catching up with him when we were in China last year and the years before, so we're honored to be here tonight. So what I'll do with you now is I'll share my screen. I've got a presentation I want to just take you through. We will answer questions at the end, so maybe just jot them down. Make sure that you don't forget what questions you need to ask. And what we'll do is we'll come back on live on screen like this at the end where we can then answer your questions. So just give me 1 second while I change my screens. Okay. All right, so just getting it ready here. All right, so thanks again for giving us your attention tonight. We should go for about 40 odd minutes. And if we have questions at the end, we'd love to take them from you. What today is the presentation that we want to go through is the agenda is who we are, a wrap up of the Australian property market, residential, part of our strategy in terms of investments in property, what is a property trust and what it looks like, some investment opportunities. So a little bit about us. Red was established back in 2002 with myself and Benjamin. We currently manage a property portfolio of over $125 million. We've got a few years in finance and superannuation, and most recently we are partnering in an accounting firm here in Australia. So let's talk about the residential market in Australia as an overview. Bear in mind, the stats that you're going to see and the information that you're going to see is only related to residential. So nationally speaking, the Australian market demand for property has increased slightly by 5.2%. Throughout this presentation, guys, just keep in mind that I don't want to, or I'm not really stuck on the numbers necessarily. It's really the story that these numbers tell me. And hopefully you'll get the understanding of that yourself. But if you break it down between houses and apartments, we can see that the housing market has done a lot better than the units or apartment market in Australia, with the numbers on the screen there. If you look at it from a national view, and Australia has around 7 or 8 different major markets, and those are all the major cities listed here. One thing, just as an observation point, if you stand back and look, some markets have done well, some markets have done not so well, and some markets have had a decrease. So if you go sort of around the country, we'll start at the top. Darwin is one of the more northernest parts of Australia, has had a correction of just over 5%. Brisbane hasn't really done all that much. It was expected to do a lot more. Sydney's had a bit of a correction. Over the last sort of 5-6 years, Sydney's had an awesome property market. It's had a bit of a correction on the back of some lending that's been done here in Australia. Canberra, on the other hand, has had a 7.7% increase. Melbourne very similar to Brisbane, hasn't really done much. Hobart, down in Tasmania, has outperformed the country. It's been flat for the last nearly 15 years, so they're catching up. And Adelaide in the middle there, 3%, and Perth is still coming back slowly on the back of the buying their way up. If we look at every market in a bit more detail, and again, the numbers should tell a story. I'm not hung up on the actual numbers. But if we look at Sydney, and Sydney is Australia's biggest property center, it's had a negative 22 decrease percent or demand on all dwellings. This is a combination of housing and apartments. But if we break it down, further, we can see that the demand for housing has had a negative 22.5%, and apartments very similar. What is interesting about these numbers, though, is the median house price. On the back of the correction that it's had, the median house price has come down by just over 7%. So Sydney right now is having a bit of a correction. If we look at Melbourne, the demand for housing in Melbourne has also decreased just over 6%. Although the median house price has had a very slight increase. Housing, bit more of a decline as opposed to apartments. What is interesting though or good about Melbourne is it points the picture or points the finger at future growth potential. Melbourne is predicted to be Australia's largest city in the next 15 to 20 years. So even though we do see these corrections right now, Melbourne is poised for some growth in the years to come. If we look at Brisbane, Brisbane has had a slight increase of nearly 6%. Median house price has inched slightly, and demand for both housing and apartments has had an increase. Brisbane was expected to do a little bit better than what it has. Some analysts say that because of the oversupply of some areas of apartments, specifically around the CBD, has contributed to the slowdown. But again, Brisbane is a strong market, so we look forward to some growth in the years and months to come. Adelaide has had a 2.7% increase on demand, interestingly though, the median house price has had a 3% increase over the year-on-year return. So that's pretty interesting. What is interesting though is the demand on housing has outperformed apartments. If you know anything about Adelaide, apartment market is not as strong or in demand as housing. Hence, housing will always outperform apartments in the Adelaide market. If we look at Perth, the demand has increased, but if you look at the median house prices had that decrease, that's simply because of the overall market is coming out of a correction. Demand for housing, as opposed to apartments, is increasing as well. Again, this shows signs of potential market growth. You always want to just make sure that you time the market well, and we'll touch on that in 1 second. Interest rates in Australia have or are currently at a historical low. Over the last nearly 3 years, there hasn't been a change in interest rates, which poses a great opportunity for investments. Gear your investments, borrow from the bank. It's making the yields attractive, a return on investment attractive, simply because the interest rates are at an all-time low. And I'm just looking here at Benjamin here. If he feels the need to jump in and add anything, I might just go ahead and jump in. Yeah. Let's have a look now at the commercial market, and I'll get Ben to present more on this here. Ben, over to you.
Hey guys, yeah. So on the commercial side of things, which for those of you that don't know much about the commercial property market or even the residential property market in Australia, but the two markets don't always move in the similar sort of cycles. Sometimes there can be growth in some markets, in commercial, etc., whereas the residential market might be flat or have a bit of a downturn, a bit of a correction. So it's interesting to see how the commercial property market has performed over the last sort of 3 to 10 years. And what we're seeing with these column graphs here is on the one on the left, where it shows all property, the colored graphs are your 1 year, 3 year, 5 year growth and 10-year growth for all commercial property. Sorry, pushed to all commercial property in Australia. Done it again. Sorry, guys. And if we can compare that to over the far right here with equities in the bond market, you can see the growth in commercial property has outperformed equities and bonds in Australia over the last 10 years, and particularly over the last 1 to 5 years, there's been a strong growth in commercial property versus equity and bonds. So we want to dive a little bit more deeper into that. And I know this is a bit of a complex graph, so I'll take you guys through it slowly, because it's got some really important data to understand how the commercial property market cycles, particularly here in Australia. So what we're seeing here is a graph of commercial property investment as a whole, and it's saying that if we were to invest $100 in the commercial property market as a whole, over the next 30 years of this graph, we'd see that we would have had considerable growth in the index, almost sort of 10 to 15 times our money. And what this is taking into consideration is both the capital increase of the property and also the income yield that we receive on a yearly basis from the property. These more squiggly lines and graphs here purely take into account what the growth is per year of each of the different commercial property sectors. But I'm going to slide across to the next graph, which gives a clearer picture of what we're looking at. So what this next graph does is it breaks down the growth rate of the commercial property market. And what we see here is the blue lines, or the yellow line which follows the blue lines, is the total return that we will receive from commercial property, and that is the capital return and the income. And there's two particular points in the chart that I want to point out. There's over this part here, which is the 90s, so 91, 92, and basically what happened there is we had record high interest rates. Interest rates were over 18%. And obviously that caused a huge correction in all property markets, but particularly in the commercial property market for capital rates. And over on this side here, what we notice here is through the GFC in 2008, 2009, obviously the capital growth rates for commercial property dropped off, just like every other market corrected itself during that time. But importantly, what I want to show and focus on is the orange graph. And what the orange graph represents is the yield or the income that we receive from the rental property in the commercial property market. And what you can see that it's very consistent over the last 30 years. And there's a consistent return of between sort of 6 and 8% net return that we receive from commercial property. So during these periods where the capital growth did fall off and correct itself through the GFC and obviously the high interest rates, what we see is the income still remains very consistent. And the main reason for that is that there obviously are longer term leases through commercial properties. So with residential properties, generally your lease or your residential agreement is normally for 12 months. And you're renewing with different tenancies each 12 months. With commercial properties, typically you're looking at between 5, 10, and sometimes even 15-year leases, so that even though there is a downturn in the market from a capital point of view, we're still receiving our income and our rental income along the way. And that is why we've been able to get such great consistent returns from commercial property over the years, that we can still receive that rental income. And that's important because the rental income is what helps us pay the loan. It's what helps us pay all the outgoings of the property. It's what helps us hold the properties through these times where perhaps in residential property, people are forcing to sell their properties, or even in shares and equities that are obviously taking a big hit in the market. Okay, so what I want to move on to is the structures that we might use to set up our investments. And with our investments, we set them up all in unit property trusts. And there's a couple of reasons why we do this. The first one is the legal ownership. So all of our investors that invest in any of our property investments, they all have legal ownership of the property. So they're not investing into our fund or into our business, let's say. They are actually investing into the property, and they all have legal ownership of the property. The other reason is that when it comes to lending and borrowing money for the property, there's no legal lending liability to the investors. So the bank obviously takes security over the property, but there's no risk to the investors, because there's a limited liability in terms of the loan involved. Obviously, there's still tax benefits. If we set up the same structure but in a company structure or a corporate structure, then we as investors wouldn't receive any tax benefits for owning the property. So with a unit trust, we get to still receive the same tax benefits and the legal benefits of the ownership structure. And importantly, for a lot of our investors overseas, it's easy to have foreign investors invest into our unit trust and our properties. It allows them to invest without having to borrow money themselves in Australia, and they still get to hold legal ownership in property in Australia.
Yeah, Ben, so that's a good summary there. Legal ownership, no lending liability to the investor directly, tax benefits, and foreign ownership is perfectly well. I just want to touch on a couple of our past projects just to give you an insight of what we've done before I move into one of our current projects, just to give you an example. So in the past, this one here, we called it the Milton project. It's in Milton, Queensland, which is a suburb of Brisbane. Along the riverfront, you can see the Brisbane CBD in the background. This one here currently nets an 8.8 return. The strategy behind this property here was just to buy and hold long term. What happened was it's less than a kilometer from the CBD. A brand new building got built with the commercial premises on the bottom. Had 4 anchor tenants and residential towers on top. Yeah, so it was a long-term buy and hold. The investors are loving it. More recently, we looked at a project here in South Australia. We call this project the Good Life Gym project because the tenant was a Good Life Gym. It's one of the largest branded gyms here in Australia. What we liked about this project is a couple of things. One was the proximity to the CBD. It was less than 3 kilometers from the business district of Adelaide. It had a 12-year lease on it. The cash flow projections were amazing. It was a single tenancy asset, which is something that we tend not to like too much. But because of the 12-year lease, the over the market payment they were doing, so the income was exceptional. Once the team, Benjamin and his team, did the due diligence, however, is where we sort of started losing interest in this project. One of the major things that we look for is the stability of income.
I might just jump in, if you don't mind, Adrian, because obviously our team worked on the due diligence for this considerably. I just want to take you back to that graph that I showed you about the consistency of income that we can receive with commercial property. Well, that's why the importance of doing legal due diligence is so important, because it's all good to have a lease that has 12 years to run on the lease. But if the tenant walks out in 2 years' time and we can't receive that income, then it's pointless having a lease in place for 12 years. So we work with different, some of the biggest law firms in Australia, or they're actually international law firms, to make sure that whichever property or investment we're going to go into, that the tenants are strong and secure, they have corporate guarantees in place. And just importantly, we're going to receive the income not just this year to come, but we want to make sure we're going to receive that income for 12 years' time. Because one thing that nobody can guarantee in any property market is when the market is going to go up and when we're going to have some corrections in the market. And what we don't want to have is that if another GFC were to take place in maybe 3 years' time or 5 years' time, and then the tenant walks out and we don't receive our income, we need to make sure that income is secure from day one so that we can continue to receive it for the next 12 years. So with this particular one, our lawyers went through all the legal documents and all the leases, etc. And they came back and said there's no strength in the deal. When the Good Life Gym had changed ownership, there was no longer any corporate guarantees in place. So effectively, whilst it all looked good on the surface, which is an easy mistake for people to make, it all looked good on the surface, but when you dig deeper, you found out that if the tenant walked out tomorrow, then effectively we'll be left holding a vacant building from there.
Yeah, no, that's a really good point. What I was trying to say before is there's nothing worse than going into investment thinking it's going to be a great result for you. You've overlooked one or two things, and then it doesn't turn out that way. So we take our time. We spend a bit of energy and money to make sure that our investors really get the returns that we project. Most recent project, we call it Mount Gambier because it's in the second largest city in South Australia called Mount Gambier. Just a brief history on this particular project. It was a hardware store to begin with for a very long time. It relocated. The owner stripped the entire building. Everything's brand new, from the roof to the ceiling to the cladding to the bitumen to the electrical, the plumbing, air conditioning. They refurbished it to a pristine level. So the strategy behind this project here was to purchase, buy, and hold. It's netting at the moment 9.12% to the investors after all costs. Cash flow, the internal rate of return of just under 14%. So this property here is the tenants are anchor tenants. Not only are they anchor tenants because they're ASX listedly backed, guaranteed sort of entities, the demographic supports these types of businesses. It is a regional town, city, I should say. There's no point in investing in something that the demographic won't support. These three particular tenants fit the demographic. One of them doesn't even have any competition in the area, so it fits beautifully with the area. So I want to just take you through an opportunity that we actually have live today. And as I said at the beginning, I would love to take questions at the end. So this commercial investment, of course, a unique thing about this one, it's off market, and I'll come back to that point in a minute. The net yield is just over 9% per annum. It's less than 10 kilometers from the Adelaide Central Business District. It's got national brand attendance, and the leases are already in place. We call this property here 838 Marion. I'm not sure how clear that is on the screen. Nonetheless, I've got a short little video that'll describe it to you in a bit more detail. Hopefully the audio will come through.
My name is Adrian Rivish. I'm from Red Wealth here in beautiful Adelaide, Australia. I'm here to talk to you about an investment opportunity that offers a net return of over 14.7% per annum called 838 Marion. Our team here at Red Wealth has many years of property and finance experience, and we have currently over $125 million under our management in the property portfolio alone. At Red Wealth, we specialize in commercial and residential opportunities with two major objectives: reducing our investors' risk and increasing our investors' long-term returns. 838 Marion is an off-market opportunity offered to you exclusively through us. 838 Marion is a direct property investment opportunity. It has a cash flow return on investment of over 8.8% per annum, paid quarterly to the investor. In addition to this high cash flow return, 838 Marion presents great long-term capital growth potential, resulting in a total net return of over 14.7% per annum to the investor. It has nationally franchised tenants with long-term leases already in place and is located less than 10 kilometers from Adelaide's central business district. Adelaide is the largest city in South Australia and is home to some of the world's best winemakers and global exporters such as Penfolds and Wolf Blass, who are situated in the world-famous Barossa Valley and McLaren Vale regions. 838 Marion is positioned in the heart of Adelaide's growth corridor. Within 2 kilometers of 838 Marion, there are economic growth projects with over $1.5 billion in government and private spend, government infrastructure projects at over $2.9 billion, including newly constructed freeways and rail projects. There are new demographics of people from across the globe demanding housing and education within the newly upgraded world-class Flinders University. Global businesses such as Siemens have already moved into this area, and the largest shopping center in the state, Westfield Shopping Centre, is less than 1 kilometre away. 838 Marion is among an exclusively held commercial precinct. Its land is just over 6,000 square meters and is located on one of Adelaide's busiest major roads. 3 of the largest global commercial property valuers gave us a market valuation of the current Australian retail market. As you can see, most of the current tenants are paying within the low end or below the current local market value. This reduces the risk for our investors of the tenants ending their leases, but it also gives us the opportunity to increase rents, resulting in stronger returns and increased capital value for the property's investors. 838 Marion is ideal for investors who want to diversify their investments, have low risk, high yields, and gain exposure to the lucrative Australian commercial property market. For more information about this exclusive investment opportunity, download the information summary brochure and learn more about this incredible wealth building property, 838 Marion.
All right, guys, thank you for your patience on that. I'll skip some of the slides because you would have already seen that in the video, but I will stop at a couple of key things, and one of them is this one here. This opportunity is off market. Why that excites me is the quality of these sort of assets don't go for sale on the open market, and it's exclusively offered to us. So we're honored and privileged for that. But more importantly, it gives our investors an opportunity to actually own part of such a quality asset that isn't readily available to the open market. So if anyone out there is interested in owning this, it can only happen through Red Wealth. So as I said, it is exclusive, it is off market, and we're grateful for this opportunity. I want to touch on a couple of other key things, and that has to do with the price per square meters and the rents. So I'll skip over some of this area about the demographic and the infrastructure. A lot of government projects and spends. There's a lot of information here which you can also download in the information brochure if you so choose to inquire more about this project. But I want to get to this screen here, which talks about the tenants, which I'll just ask Ben to touch on a couple of key things, and then I'll come back.
Yeah, so another aspect of the due diligence that our team will go through, obviously really important, is the legal due diligence to make sure that the leases are strong in place and that we will receive our money. But importantly, it's also important to see, the current tenants that are in place of the buildings that we're looking at investing in. What price are they paying per square meter compared to what the market is paying? So if they were to walk out at the end of their lease, are we going to be able to renew their tenancy, or are we going to be able to increase them with a better quality tenant paying a higher rate of per square meter? And so with this particular property here, we had valuations done, more importantly, on the price that they were paying per square meter, and the range in this particular area is about $150 to $300 per square meter. And what we found with the current tenants in place, they're paying well below what the market average is paying. Now, some of the newer tenants that have been put in place over the last year or two, such as Blackwood Sound, Scooter Hut, Junction Australia, they're sort of paying now more in line with what the market is. But there's some of the longer standing tenants like Haggleco that have been there for a long time and have a large area. And this poses a great opportunity for us to increase the rent that they're paying if they were to move out, and we'll get a better quality tenant, or we can replace them with another better quality tenant at the same price they're paying. So all of this points to reducing the risk to make sure we're still going to always get the income from the property, and importantly, increasing the capital value of the property. So whilst we're buying the property off market, we're also being able to buy it under market value by using a bit of restructuring strategies.
Yeah, I mean, if this graph was in reverse, where at the time of acquisition, the tenants are paying above average or even on the upper price per square meter according to the market, the risk for us as investors in the medium to long term is if they leave or they choose not to renew, replacing that tenant is going to be a lot harder than it is at the current price per square meter that they're paying. So the numbers that we're stating here is on the now price per square meters. Our objective is over time and through conversations to increase. Obviously, it's not going to happen as it's depicted here, but there is a greater chance of increase, therefore increasing the income to the investors, increasing the capital growth, increasing the quality of the asset, and it's a great result moving forward. Anything else you want to add there, Ben? No,
that's good on the rental due diligence. Yeah.
So a couple. This is my last slide here, guys. So if you've got any questions coming up, just get them ready, because we love to make sure that we can answer them for you. So some of the details on this investment: it is a purchase price of 11,250,000 Australian dollars. The net return, as you would have noticed from some of the slides, they have changed. They are not constantly changing, but they are changing, increasing due to some of the rental increases that have occurred since we first looked at this project. Renegotiating of leases are taking place. So we started off at 8.8. We're at 9.04. It's going to be 9.2 soon.
That's actually a good point you make, because a lot of our projects, we don't just find them on the market and put them together within 2 or 3 month periods. So this particular project we've been working on for coming up to just over 2 years now. And we were able to option the property back 2 years ago. So in that particular time, we've been able to already capturing some of the market growth that's already taken place, whereas the investor gets in at the original price that we optioned the property at over 2 years. So effectively, they're being able to get in with 2 years capital growth already in the market. So
that's good. So guys, the minimum investment here that we're seeking is 100,000 Australian, anywhere up to 5 million. The internal rate of return, or the overall return, is going to be sitting just under 15% by the time we settle. There's a lot of due diligence that we've done on this project, and it's all available for you in the information memorandum if you choose to download it.
Just on the returns with all our projects. So the cash flow return, the 9% that you see up there, that's all paid quarterly to the investor. So they'll receive that net of any fees, of any expenses and outgoings for the property. They'll get 9% into their account, paid quarterly on their investment.
So just to sum it up a little bit, is the Australian market a good place to invest? I believe it is. Let me just get my computer here working again so everyone can see us again. All right. So yes, the Australian market, is it a great place to invest? Yes. Do all the markets in Australia respond the same? No, they don't. Is there a difference between residential and commercial? Well, yes, there is, as we've identified. Our biggest objective is to make money for our investors, reduce risk. We want to offer a passive investment because we manage the whole entire project from the beginning to the end, and it is a medium to long-term opportunity. So it's not like we're going to invest today and exit tomorrow. Love to answer any questions. Type away or sing out. We'll see how we go with the administrative of these questions. If you can't get through on this presentation, Stephanie and the team will have our email addresses. We can also exchange information that way, or if you want to connect with us on a one-on-one phone call, happy to do that. But yeah, over to you guys. If anyone has any questions, any concerns, any feedback, I'd love to address them now. And Stephanie, please step in if I can't see any of the questions being asked. Otherwise, guys, I really appreciate your time. We would love to make another trip to Malaysia sometime in 2019. But yeah, open to questions and fire away.
Okay, I got a question here. What is the payback period for investors?
Payback period. I'm not quite sure how to answer that question. I'll give you a bit more information around how it works, so maybe that'll answer the question indirectly. The way it works is assuming someone pays minimum of 100,000, we will be making quarterly payments to the investor. We don't have a minimum time period of how long an investor chooses to be with us. So the payback period, well, we have investors with us that have been with us from the first project from day one. Yeah.
If they're talking specifically about the time frame on how long they need to stay invested in the project, what we advise everybody, like most property investments, it is a medium to long-term investment. But like Adrian said, there's no minimum amount of time frame. So an investor can sell their units at any time if they needed to get out of their investment. And we facilitate that with them. There's no open market for it, so obviously it's not like like a share market or equity market where you can just sell it on the open market. We do need to find another buyer for their units, but there's no minimum lock-in period or time frame that they need to be invested into the project.
Yeah, I'm not sure, Terence. I hope that answered the question.
Yeah.
Ask again if that didn't. We can explain it another way.
Yeah, the same investor got the second question, which what is the investment amount?
Okay.
Yeah, I was going to touch on that. Adrian mentioned that minimum of 100,000. The minimum 100,000 investment amount is for our locally based investors. For overseas investors, we can take as low as $20,000 investments. So the minimum amount of investment is $20,000. And obviously that will get allocated in units to the investor.
Okay, there is another question here. Any withholding tax for Malaysian tax resident?
Sorry, Terence, can you repeat that again? You broke up there. Please say it again.
Sorry, any withholding tax for Malaysian tax resident?
There is. Our accounting department can be more specific in terms of based on obviously Malaysia citizenship, etc., and how much we need to withhold, and the tax benefits that they'll receive, etc. So maybe that question I'll come back to you or in an email more specific, because I'd rather the accounting team answer that. Obviously, that's why we've got the accounting firm, so they can be specific with all our investors as to what they will and won't receive from the investment.
Yeah, actually, that brings a good point, which I'm not sure we covered in our presentation, just as a side note, and that is depreciation. If there is depreciation on the property, we don't hold that. That gets passed on to the investors. So all the numbers that we've depicted here do not include any depreciation that the investor can enjoy. Yeah, so hopefully that's another sort of a side angle to it.
Okay, regarding the payback period just now, so this investor also so there will be a quarterly dividend payout according to the yield per annum.
Yeah, so it's a quarterly payment paid to your account. Yeah, very simple, very clean.
Okay, I have another question here. Is this kind of property trust regulated, and if yes, it's regulated by who?
Yeah, so it's not a listed property trust. So when they're asking if it's regulated, so it's audited. So we get all our trusts audited by independent auditors and accountants, etc. but it's not regulated to the point of a listed property trust. So it's not a listed property trust, if that's what they're getting at when it comes to the regulations. So obviously, ASIC has certain requirements when it comes to property trust, how they're run and managed, etc.
Just explain what ASIC is.
Oh, sorry, ASIC. Yeah, okay. So ASIC is the Australian Securities Investment Commission. So effectively, the governing body in Australia for corporations and businesses, etc. So they have requirements as to how the trusts are managed and run. And independently audited, but it's not a listed property trust on the Australia.
It's not listed on the stock market.
On the stock exchange.
It's a privately owned. Yeah.
Okay, so for an investor, how can an investor exit, or what's the exit plan for investor?
Sure. So as I mentioned before, there is no on-market, secondary market for them to sell their units online, let's say. So effectively, we have a strategy threefold. If an investor comes to us and says, hey, I need to liquidate our units for our investments, the first things we do is go to the existing unit holders and we'll say to them, hey, someone wants to liquidate 50,000, 100,000, whatever the number might be. And generally speaking, what we've seen so far is that all those units get taken up by the existing investors in the project. If there were still some left over, we would then go to our wider database of investors. So sometimes investors get into one project and they may not be ready to get into the next project. If someone wants to sell their units, they might be in line, and we've obviously got our database and they're ready to go, and we'll offer it to them. And then the third way is that the investors themselves could find another buyer of their units. So they could effectively find another person to buy their units, and we would help transact the unit sale for them, and they can receive their money from there. So it's not an overnight process where you can receive your money in 28 days, in 24 hours. There's a minimum period of 28-day notice that we need. But effectively, once we find the buyer, then we can get their money out and into their account as soon as that transaction's taken place.
Okay, so is there a minimum holding period for investor?
No, there isn't. No, but there is no minimum or maximums. But what we do always say to all investors is the purpose of these investments that we do is for the medium long term. So we don't stipulate any minimum or maximum. No.
Okay, so that means if the property is making money, I can hold the property trust as long as I want.
Correct. Yeah. Our strategy with almost all of the properties that we invest in is generally a long-term hold based on their locations and the quality of tenants. So our strategy is to hold these investments for not just ourselves or the investors that we're investing with, but also for generations to come, because the location of these properties is really, really strong in terms of location to the CBD and things like that. So it's always a long-term strategy with these properties. But that doesn't mean the investor has to hold it for the next 20 years. They can, and we hope they do invest with us for the next 20 years, but effectively there's no minimum time frame they need to be invested in the property.
So is there a case that you'll sell the property when the price is good, and what happened after that?
Yeah, that's a good question.
That's a great question. Obviously, we don't control how the market is or what happens in the market. We do our due diligence and then we work with it. So obviously, if the market has some considerable growth and someone comes to us with a really good offer, then we will consider the offer. And effectively, if we do then liquidate the property and sell, then obviously all the capital return for the investors will go back to them, including all the capital growth. And that's why we like the legal structure of the unit trust, because legally everybody owns a piece of that property. So it doesn't matter who sells that property, etc. Once the sale takes place, those funds must be distributed to the legal owners of the property, which are obviously all the investors there. And one other point I want to make, Terence, and obviously to the rest of the investors online, is with we haven't talked about our fees, etc. That's all outlined in the information memorandum, which you can pass on to everybody. But all those returns that we projected are all net of any of our fees that we take for managing the property and finding the property. But more importantly than that, our fees that we take from managing and finding the property, we keep as units and equity in the property. So we don't take it as a cash payment at settlement. We own a piece of the property just like every other investor does. We invest our own funds into the property because our view is we're building our portfolio just like we are with the rest of the investors. And we want to be holding the same property that our investors are holding. And that's what we bring confidence in what we're doing in the market, that the investors are investing in the same thing that we're investing in.
Okay, we have another question here. Who is the trust management company?
Yep, so the trustee of the company is our business, Red Wealth. As I mentioned before, we have an independent auditor that audits obviously what we do in terms of managing the trust. But in terms of managing the trust, it is our company, Red Wealth. That's what we specialize in, finding the property, managing the property, and managing the investment.
Yeah, most of our investors appreciate the fact that it's a passive approach to investments. Otherwise, they could have just done it themselves. So we take all the headache out of investing, all the reporting, all the dealing with the agents, dealing with the leases, dealing with the maintenance. It's all done for everybody.
Okay, I got no more question here. Is there any question from investors? You can still ask. Any more questions?
And like I said, Terrence, before, like I said, if there is another question after we finish, please feel free to forward that to me in an email. We'll do our best to answer that. And if someone wants to get more information from us, we're always available, so not a drama.
All right. I think there are no more questions here. For you, if you are interested to know more about this project, you can leave a comment down here. I will send you a information document to your very detailed information provided by Red Wealth. And if you're a Morgan Capital member, you can actually log in and watch the video just now, and also you can also download the document inside Morgan Capital. So for those who are not in Morgan Capital yet, you want to find out more about Morgan Capital, you can also leave a comment there. We'll call you or email you to explain about Morgan Capital and to explain more about this investment opportunity. Adrian and Ben, is there anything to add on from your side?
Just wanted to say thank you to MasteryAsia for allowing us to speak to you. Terrence, hopefully next time we're there, we'll get to shake your hand because I haven't met you yet face to face. And to all the investors, I wish you all the best for 2019.
Thank you, everybody. Appreciate your time, taking some time out on a Tuesday evening to come and to listen to us about Australian property. So once again, we thank you and look forward to speaking to you.